Let's begin with a foundational question. How exactly does private information, knowledge held by only a select few, get reflected in a public market price? It's a common assumption that this process is somehow automatic, but it's not magic. It's a very real and, as we'll see, quite fragile, mechanical process driven by capital-constrained agents. Today, we're going to deconstruct those mechanics.
Here's our path. We'll start by questioning the core assumption about how information enters markets. Then, we'll examine trading as the primary revelation mechanism. From there, we'll analyze the costs of informational asymmetry, explore the inherent paradox of market efficiency, and conclude with how this entire system is constrained by the availability of capital.
So how does this transformation from private knowledge to public price actually occur? It's tempting to think of prices as simply updating in response to new information, but that view obscures the critical mechanism at play. Without an active process, prices would only ever reflect publicly available news, leaving a vast amount of private insight completely unutilized by the market.
Okay, let's start there with our first section. We need to move beyond this simplistic idea of automatic price adjustments.
The fundamental premise is this. Information is not ambient. It doesn't just seep into prices. It has to be actively introduced through a specific mechanism. If no one were to trade on their private knowledge, prices would remain static until a public announcement. The entire concept of price discovery would be moot.
This brings us to the primary mechanism itself, the act of trading. Markets are far more than just venues for exchange. They are, in fact, complex signaling systems for information.
Let's trace the causal chain. It begins with an informed trader acquiring non-public insight and executing a position. Now, market makers observe this order flow, but they can't know the underlying motive. Is this an informed trade, or is it a simple liquidity-driven transaction? To mitigate the risk of trading against someone with superior information, what economists call adverse selection, they adjust their quotes. The bid-ask spread widens and the price begins to move. And right there, the information starts its journey from private to public.
This entire dynamic is what we refer to as price discovery. And it's critical to understand that this is a continuous, imperfect process. It's not a singular event. It's an ongoing convergence driven by the aggregate activity of all market participants, each trying to infer the knowledge of others. But this process is not frictionless. The very information asymmetry that facilitates price discovery also imposes a direct cost on the markets, specifically on liquidity. Imagine the dilemma for a market maker. Their business is providing liquidity, but they constantly face the risk of adverse selection. A large sell order could be from a pension fund rebalancing its portfolio, which is uninformed, or it could be from a trader who possesses negative private information about the asset's future. The market maker can't distinguish between the two. And what is the direct consequence of this uncertainty? Well, to compensate for the risk of systematic losses to informed traders, market makers make it more expensive for everyone to transact. The bid-ask spread, the gap between the buy and sell price, widens, so liquidity becomes more costly precisely when information asymmetry is highest. This quote captures the essence of the issue. The transaction cost, that bid-ask spread, is not merely a fee. It's intrinsically linked to the market's function as an information processing machine. It's the price participants pay to operate in an environment of informational asymmetry. This brings us to a really fascinating and fundamental paradox at the very heart of the efficient market hypothesis. Think it through. A perfectly efficient market, where all information is instantaneously incorporated into the price, is a logical impossibility. If prices were always perfectly correct, what would be the incentive to expend resources on research and information acquisition? There would be none. The production of information would cease, and prices would no longer reflect fundamental value. So a realistically efficient market must contain some degree of mispricing to incentivize the very activity that keeps it efficient. This is the core of the famous Grossman-Stiglitz paradox. It posits that perfect informational efficiency is an unsustainable equilibrium. Without a profit motive for gathering information, the flow of that information would stop, and the market's efficiency would collapse. The implication, then, is that a functioning market must exist in a state of tension. It requires a delicate equilibrium, one that balances the cost of information production with a degree of pricing accuracy. A certain level of inefficiency is, paradoxically, a necessary condition for an informationally responsive market. And now for our final section, where we connect this abstract process to a very tangible constraint, the availability of financial capital. You see, information alone is inert. To influence a market price, an informed agent must be able to execute trades of sufficient size to signal that information.
And this, of course, requires capital. Without the capacity to establish a position, even perfect foresight is useless.
And therein lies the vulnerability. The key actors in this process, the specialized intermediaries like banks and hedge funds, are themselves capital constrained. When their funding conditions tighten, as they often do during periods of market stress, their ability to deploy capital for informed trading contracts sharply, regardless of the quality of their information.
The critical result is that the flow of information into market prices is not constant. It's contingent on the health of intermediary balance sheets. During a financial crisis, as funding dries up, the entire price discovery mechanism can grind to a halt. Valuable information becomes trapped, unable to be expressed in the market because the capital to act upon it is simply unavailable.
This leads us to a final and rather unsettling question. If the market's core function of processing information and pricing risk is so dependent on the fragile capital base of a few key intermediaries, what does that imply about the stability of the entire financial system? It suggests that a fragile financial system and an informationally efficient market may be far more intertwined than we often assume.